So, Brian, I think we're going to get started with you. I'm going to pull up a quick graphic that I saw on Bloomberg that really illustrates the recent boom in small cap performance. And of course, we've seen some mean reversion, and we can talk about the drivers of that. But I want to look right at that spike right over here around the time of the presidential election. Can you give us a quick overview of how you were positioned going into that moment and how you reoriented after?
Well, we don't try to do too much forecasting of the future. We try to think in probabilistic terms about how we're positioning and what we think is going to happen. So while we like many others had a higher odds of Clinton winning the election, we didn't think that that was going to translate into major changes in policy that we were trying to exploit. When Trump won instead, there's the suggestion that there would be change in policy, but this is Washington, D.C. We know that the policies that are talking about changing are very complex and have a lot of contingencies on both sides that will want to have their hands in the decision making. So we didn't change our positioning very much. The market changed on us, though, and that meant that the market began putting probabilities on some outcomes that were different from what we thought they were. So after the bump, we took a look at our holdings and thought, now where has the market gone too far in discounting a positive outcome? Where has it gone too far in discounting a negative outcome? And we did tilt the portfolio a little differently after that, a little bit away from banks and financials, a little bit toward healthcare.
So you were looking at the probability that perhaps the market was pricing in campaign promises as done signed legislation.
Exactly.
Okay, got it. What are some of the policy plays that you're looking at? And if you see a little bit of a bump in GDP growth from, let's say, fiscal expansionary policy, will that make a big impact in small caps?
Yeah, I think JB and Bill hit the high points. Tax is certainly the biggest one for my companies. We're aware when a tax cut will benefit our companies, straight tax cut. If there's a change to border adjustment tax or any other sort of tax methodology, VAT, all bets are off, and it's too complex an issue, I think, for us to analyze very well, except in certain circumstances. So generally, I think if there is a tax cut, it's going to be simple. It's going to be 10% off for everybody, and that'll more or less lift every boat. So we don't have to think about that very much. I think certainly healthcare is a major issue. Again, I would be slow to rush to a conclusion about what's going to happen because it's nettlesome and we need to see how it's going to start forming. And very little policy like that, even the infrastructure plan, has actually started to form. So until we get a little more clarity on that, we're not going to be making many changes based on policy.
So looking at probabilities as you do for something like, let's say, fiscal expansion, probably not by end of 2017, or just absolutely too unclear to tell?
Fiscal expansion? I mean, you're talking about the higher, what do you mean by fiscal? Just growth in GDP?
Putting together a robust infrastructure plan, for example, that's going to fuel GDP.
Actually putting shovels in the ground, not going to happen by the end of 17. A plan maybe for 18, 19 might happen by the end of 17, and we'll consider it then. But there aren't a lot of companies for whom I could say, this particular infrastructure plan is going to translate into a lot of revenue.
Okay.
So even that, when it comes, hopefully it comes, and it'll matter for a few companies, but for most companies, what's going to matter more is just that we're spending again. The government is actually going out and spending. And that'll be good for a lot of industries.
Speaking of probabilities, we have the idea in our minds now that the Fed is going to raise rates 3 times this year. It looks like it's highly probable, but at the same time, we've been here before. We are, though, trending upward into a rising interest rate environment. How does this impact small caps?
We saw financials, especially small cap banks, make a big move up after the election based on presumably growth and the benefits of higher rates for the banks. I completely agree. We started to discount that possibility a little too highly because there are still many questions about the growth rate of the U.S. economy at this point. So we may get some of that. It may turn into a good time for the banks, but we also is going to have to be paired with the steepening of the curve. And right now, what we've seen is actually a little bit of a flattening. That's not beneficial for small cap banks. And so even if we get rising rates, it may turn out not to have the effect on stocks that people might naturally think.
So we're not necessarily seeing small cap, even financials, financing growth via acquisitions. So taking out a lot of liability on their balance sheet in order to finance these, any methods of growth in the future.
You're certainly seeing some banks. There's quite a bit of merger activity in banks still, consolidation, cost cutting, as most small cap banks are debranching to some degree. So that there are efficiencies that come from that, but I don't think they're basing that on expectation of higher rates. They're doing it because it's a smart business decision.
Okay, got it. We've talked about expectations for policy. We've talked about it for interest rates. Now let's move on to volatility. So we can either limit it specifically to small caps, and I believe the Russell 2000 saw a low point in volatility in March. Can you give us a little bit of a sense on what you see coming forward, particularly for small caps in this particular space?
It's really been since 2008. Active management has not had inflows at all in the larger equity market in the U.S. And a lot of the inflows into passive have not been to broad indices. They've been to sector funds. They've been to ETFs much more than the indexes, the natural index fund that we think of with John Bogle. So that's not really passive money. It's active money that's attacking a sector. And it does, to some degree, I think it has been driving sectors high and low in unison. And that has meant that for us, it's meant a little more tilting sectors one way or another than we would like. We're not naturally inclined to take a lot of sector risk because we don't feel like that's our strength. Our strength is the bottom up, investing in a company that we understand, and we have a clear investment case on why that's going to outperform, why it's worth more than the market says it's worth. But when you see the entire biotech sector in 2014-15 just rise to a EV to sales level that it hadn't been since 1999, you got to be concerned about that. And after post-election, we saw financials do a similar thing. You got to be concerned about that. We can still pick a couple, but it's very hard to be overweight the sector in that circumstance because the stocks are just overvalued. So yes, it does give us opportunities, but it's dangerous too because we're going to be underweight, and then if that sentiment continues for another year or two, we're gonna look stupid. We think in the end it's going to work out, but I remember 99, 2000. That was a tough time for people who were right.
This actually tees us up nicely for a discussion of valuations. If you talk to someone who's just looking broad-based at global equities, they say the U.S. is overvalued. Do you agree with this sentiment, and how does it apply to small caps?
I mean, that's the beauty of small caps. There's so many gems hidden in all different kinds of places. It's got much greater variety than large cap, and you take a lot of less issue-specific risk when you omit something. I mean, if I'm an energy investor in large cap and I don't buy Exxon, I'm making a big bet on Exxon. Not the case in small cap. So we can look, we can find what we need, we can try to find stocks that will help us balance out our risk exposures. I would say that, looking generally at the market, the Russell 2000 market, there is reason to be concerned, in my opinion, about valuation, about it being high. It doesn't mean that we're going to cash. We don't make that kind of bet. We try to stay probabilistic. We say where can we tilt that will add value in a multiplicity of scenarios in the future, because I may not think that the U.S. has great potential for growth right now, but not many people consistently get that kind of call right over time. So I don't want my portfolio to reflect me. I want it to reflect odds, the odds of what may happen. Right now, it's probably a little more likely that we don't get a 40% rise than it was 4 years ago because of where valuations are generally, but there's still plenty of things to buy, still plenty of places to invest.
I'd like to move a little bit further into the discussion of the opportunity set right now. And I think, Brian, I'm going to start with you here. We see a lack of research coverage in small caps. Does this present issues or opportunities in your view?
I think it's an opportunity. I mean, obviously, it makes it harder to dig up information, but not to slander anyone, it's been a little while since I've seen a lot of value add from the sell side generally in their research anyway. I can pretty much go to the company's documents, to their competitors' documents, and figure out what I need to know about the industry. So it's an issue that I think, maybe it does mean that good companies are a little bit better hidden than they are elsewhere. But I've got a lot of strong competitors. I don't think that there's an efficient market out there in small caps. People are looking every day. There are thousands of people buying every day. We still have to do our work and stick to our knitting. But again, the character of small cap that is liberating is how open the field is, how you can go anywhere you want, you can go where no one is. There's never a crowded spot.
Brian, how do you think about your relationship with management?
Well, we always want to know how they think. Do they think what we would call correctly about their business? And one of the things I think that's actually nice about not having depth in management teams, often in small caps, is that they're not trying to hold their fort. Their main concern isn't am I keeping everyone else at bay? Am I going to be let go if I take any risks? They're out there taking risks because they're running the company, and if they fail, it's on them, and everyone gets hurt. So we want to know that they're making decisions for the right reasons, that they're thinking very carefully about capital allocation, that they're making investments when those investments are profitable, whether it makes their number for the quarter or not. I've had some infuriating conversations with companies who were otherwise great, great product, smart management in many other ways, but they had this one thing where they had to make their number at the end of the quarter, so they wouldn't invest marketing dollars where they knew it would be economically profitable. That's crazy. So we find a lot of our, we're a core fund, we have growth and value. Ones that we're going to hold for a long time are going to be the ones who are building something and making investments. And the best kinds there are when they are losing money now, or they're making very little money now, or their profitability is being masked by the fact that they're making investments, and people who are looking at PEs or whatever are missing that. That's where we can really hit a big home run. So we want them just to be thinking economically and not thinking about their jobs and not thinking about Wall Street, not thinking about the analysts and their expectations, just doing their jobs. And I guess one of the best at that right now in our portfolio is the CEO of Murphy USA. It's a gas station company. They mostly have their gas stations on Walmart parking lots. So this is not a sexy business where they can do a lot of tricky things, but the man who runs it is absolutely in tune to everything that he can do to add value. Every cent that he can take off with his gas shipping through pipelines instead of picking it up at the gate, everything he can do, he is doing for an economic reason. And you should go listen to his presentations because he's fabulous. That's what we want to see in a manager. When we find that kind of guy, we go with it, and we stay owners for a long time.
Brian, lastly to you, sectors of opportunity that you like this year.
I have an easier time outlining sectors that I think are difficult to find opportunities in. I would put financials, banks, REITs, utilities, all in that category. I would put energy in that category right now, though it's getting a little better. I think where we found the most in the last 3 months or so has been healthcare. As we noted, that took a little bit of a beating after the election. That helped, but biotech, after its huge run in 14-15, has come down quite a bit, and a lot of the pharmaceutical areas that are non-biotech have also been hit. Generics were in a real rut there, both large and small cap, in the last month or so. They've started to get a little bit of a bid, but that's been an area where we've been able to find a number of things. I would not say go buy a healthcare index fund, not just because I'm an active manager, but also because I don't think the sector is necessarily cheap, but that's where we found some rich trading grounds. Technology, I think there's a lot there. Technology for me is a tricky area. I've had this long held aversion to excessive stock-based comp. And it's true in the whole market now that there are companies getting away with murder by giving away virtually all of their operating profit to their employees in stock-based comp. And I don't understand how I can overlook that expense. If the company is actually worth more than it's trading for, then they're giving away something that's more valuable than cash. So why are they doing it? I don't understand. So the levels of stock-based comp generally in the sector have gotten too high, and it's incumbent upon people like us to tell them that, I think.
It's an interesting point about
a little commentary there.
Yeah, no, it's great. It's great. It's definitely a factor in the management discussion, looking at compensation structure. Can you give us an overview of your process?
Yeah, I think we find companies in much the same way. Our team has been working in small caps for a number of years. Our lead manager, my co-manager, has been in small caps for 20 years. We have a lot of embedded knowledge of various industries, so when something happens, we kind of know where the ramifications are going to go, and we take a look there. When we start working on a company, the first thing we want to establish is what are the expectations in the market. So we will do a sort of backward discounted cash flow into what the stock price is telling us, what rate of investment, what rate of return, what are the margins going to be, the sales growth to get to the current price. And we try to be as sound about it as we can. How much are we going to require a incremental return on invested capital that is at, below, or above what the company has earned historically? So we'll work on the competitive strategy of the industry, see what the history of the company's been in terms of its excess returns, and try to understand where we can differentiate from what the market thinks. Do we think that they can invest more than they're currently investing at an acceptable or above cost of capital? Do we think that they can earn a better margin than they're earning now? And again, we work probabilistically through that, so we don't create a price for what we expect the company to be worth, but rather a range, a distribution. And that curve will tell us not just where is the company now on that curve, but what is the risk profile of the company? Does it have, in a downturn, is it not going to be able to have the cash? Does it have what we would call a left tail, where bankruptcy is a bigger question, the low probability, high impact event? Or is it a growth company where the low probability, high impact event is that it's worth 20 times what it's trading for? That's going to change how it fits into our portfolio. We will rarely have something that has the left skew at the top of the fund. We'll want that populated more with high optionality companies that are trading at a reasonable price to their mean valuation in our estimation. And when we do that, one of the nice things about it is that we can focus on odds and what the valuation is under a certain scenario, so that it's less about what the analyst thinks, or and I'm an analyst too. We have 3 members on our team. We're all analysts. We all bring ideas to the table and we discuss them. And it's less personal that way. It's more about do you really think it's that likely that they'll earn, they'll grow at a 10% rate over the next 10 years? Not many companies have done that at this size. We can have a conversation about it that's objective rather than personal. And I agree with JB that the team is critical. I mean, bringing in diverse opinions on not just our individual stocks, but on our portfolio, I think adds a lot to our fund. And we can overlap all those things and see our risk profile, how all those overlapping distributions of value match, run them with a correlation through a Monte Carlo, and get a sense of, when we add an asset to it, how is it changing the entire risk profile of the fund. So that's, we know we're going to make a lot of mistakes, and we just want to minimize the damage from those mistakes. We want to minimize our behavioral errors by trying to keep things objective and not take too strong an opinion about what's going to happen.
Tell us a little bit about how you think about diversification within your portfolio.
We look at our sector exposure and at our industry exposure, really, since the sectors can have very different components to it. But we also try to look, we try to look at it as many different ways as we can. We're okay, by the way, being out of the sector or very underweight. It's just we want to know exactly why. We know, again, our forecasting ability is not going to be great. If we're making a major statement about being not in the sector, we want to have a good reason for it. And probably, since there are so many opportunities, we could find something if we looked harder. So we look harder. But we also look at it, we have a number of different quantitative models that rate stocks based on valuation, earnings quality, capital deployment, and even momentum. And we see how our fund tilts relative to the index through those factors. That helps us know a little bit. Are we making a single valuation bet that we don't really intend to make? That is going to have implications for how the fund performs in an up market and a down market. So we want to know that we're not trying to bet on one direction or the other for the market, and we generally want to have a higher quality portfolio, since that will add protection on the downside no matter what. And losing capital is our number one concern, permanent loss of capital. So we'll look at it that way, and we'll also run our stocks, our various correlations through a Monte Carlo, using the correlations of the stocks and the distribution of valuation that they might have, to see how we're skewing one way or the other at any given moment. I think it's worked well doing this. It's kept our downside capture better than our upside capture, which is what we want. We really want downside capture to be the thing that drives the fund, because that's telling us that we're not losing money for our investors. We're keeping up in an up market, and we're doing better when the market's hurting everyone.
Thank you. Brian, closing remarks. How does your solution fit into a larger portfolio?
Yeah, we're a core fund, and we try to make it so that it is a fund that can make it through many markets. We want our fund to be resilient in a down market, and we want it to be at least keeping up in an up market. So, I mean, we're in that sense, I think we're trying to make it just the kind of small cap fund anyone would want to own. But that's tricky. What we've found so far is that we have done a pretty good job keeping up and up markets and staying out of the basement in down markets. But that is where we want to be. That's where we think our process and our looking at things in a probabilistic way can help minimize losses.